Turkey is investment grade once again after an 18-year gap. Fitch upgrading the country yesterday to BBB-. A bold move? Well, here to discuss is Edward Parker, Head of Europe, Middle East and Africa Sovereign Ratings at Fitch. Ed, thanks for joining us. Given the immediate political and military tensions that Turkey faces, as well as Europe, its main export market, sliding deeper into recession, this is a bold call to upgrade Turkey, isn't it?
Well, the rationale for the upgrade was really a combination of two factors. One, a reduction in near-term economic and financial risks as the economy approaches a soft landing after overheating last year, and also Turkey's underlying credit fundamentals, including a moderate and declining government debt burden, a sound banking system, and good medium-term growth prospects. In terms of the political risk, I mean, Turkey's always had problems with some of its neighbours. It's a rough area. They haven't always got on with all of them. But despite all these political shocks and risks in recent years, the key point is that there's been a strong secular improvement in the Turkish economy. OK.
Staying in the emerging market sphere within Europe for a second, Hungary, you said before several times that if Budapest doesn't take IMF aid, the implication seems to be that a ratings downgrade is inevitable. Is that fair to say?
Well, I think things have changed over the past year in that the global backdrop has got a lot more favourable, spreads have come down, access to international capital markets is a lot easier. So Hungary has been able to finance itself, particularly in its local markets, without going to the IMF.
But you're still urging it to go to the IMF?
Well, we're not giving policy advice. That's up to the Hungarian government. Our view is that the Hungarians are reluctant to go to the IMF because they see it as having a political stigma. So if they can finance themselves in the market, they would rather do that. But I think some of the good conditions of the market are based on the view that there is this backstop from the IMF if needed.
Let's move on to Spain. We spoke to David Riley a month ago and he said that the threat of the recession deepening in Spain was the biggest risk to Spain's investment grade outlook. It's safe to say that the recession is getting worse and it's probably going to last for longer in Spain. Are we looking at a one-notch, two-notch downgrade pretty soon?
Well, we have Spain on a negative outlook, but we haven't given any indication in terms of timing. That will depend on continued analysis of events there. And actually, the recent Q3 GDP numbers were stronger than expected. But yeah, we certainly expect Spain to continue to be stuck in recession for quite a long period of time, to contract about 1.5% again next year. And the deepening recession is still the biggest risk for Spain. And the combination of that with trying to reduce the budget deficit, which is obviously very difficult when the economy is in recession.
Does the saga of will Rajoy, won't Rajoy go for official aid, how does that play into your analysis of Spain?
Well, we expect that Spain will ultimately go to the EU for a formal programme. But at the moment, there's this kind of game being played where Spanish yields have improved because there's the backstop of this the ECB coming in with the OMT, and because yields are lower, then Spain feels that it doesn't need to go to the EU and get this programme. So that can play out for a while, but ultimately, given the size of the budget deficit and financing needs, then we think that Spain will go for an EU programme.
In which case, if it does go for a programme, it will maintain its investment grades?
Well, we've said that getting a programme would actually be good for Spain. It would further take liquidity risk off the table. However, if Spain lost full market access so that they were relying virtually solely on official funding, and then we would review the rating. But if they just have a programme which anchors market access, then that means that we wouldn't necessarily downgrade Spain.
Okay. And France, many analysts say France's economic problems run deeper than meets the eye. In your view, what's the biggest threat to France's AAA rating?
Well, There are really two sets of concerns with France. One is, like many other countries, they need to further reduce the budget deficit, get back to stronger growth, and to stabilise their government debt to GDP ratio, which is heading to the 90% range. And then the other sort of risk is contingent liabilities crystallising on the sovereign balance sheet from further problems in the Eurozone, including large bailouts to other countries.
Big challenges, by the sounds of it.
Big challenges, and we do have France on a negative outlook reflecting those downside risks.
OK, just to finish up, we're talking, the mentality here in Europe seems to be downgrade. Apart from Turkey, are there any countries that Fitch has poised to upgrade again?
There's not other countries in Europe with where upgrades are sort of on the horizon, but that doesn't mean to say that individual countries that make strong improvements couldn't see some positive rating actions. I think a couple of interesting examples since the global financial crisis is that Latvia and Iceland, for example, have come back from sub-investment grade to recapture investment grade ratings. So countries that make strong improvements in their economic and financial adjustments can see upgrades.
OK, Edward, thank you very much. We have to leave it there. My thanks to Edward Parker, Head of Europe, Middle East and Africa Sovereign Ratings at Fitch. I'm Jamie McGeever. This is Reuters.